This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and we are just one day out from FOMC. So today I want to cover a little bit of a plug here. I want to cover some rate cuts. I found a guy that gets it 99%, or at least is 99% in agreement with me. And he's got that 1% different, which I'll show you, which is a really nice summary. He's done all the work for me about everything we need to know regarding the interest rate decision. Then we're going to talk a little bit about some stock market signals, because the stock market is actually under the hood looking increasingly bullish by the day. I then also want to show you some interesting Bitcoin perspectives. One that kind of suggests we are nowhere close to a bear market. At least we're not behaving anything like a prior top has behaved. And then the other thing is I found something from Jordan who shows that we could potentially be going up only forever as we embrace the S-curve of adoption. And I know what you're thinking, Camel, what do you mean up only forever? Okay, stick with me. Allow me a chance to explain it. Also, gold is doing weird stuff. Okay, gold is not yet done rallying just yet and may have found a slightly early cycle low. So, hopefully a jam-packed episode for you today. Make sure you hit that subscribe button and follow along. As soon as we get to 35,000 subscribers, we're going to throw a live stream party. We're going to give away a bunch of merchandise. We're going to give away a bunch of codes for use on camelfinance.co.uk. And I think if you can help me smash up the like button and press subscribe too, all of this might just coincide with the new reskin of the new website as well. So help a brother out, help a camel out, and let's get into today's episode. For Bitcoin, it's official. We have entered the timing window for a cycle low for Bitcoin. So this will, in theory, okay, if it's one of the 80% that occurs inside of the window, will form a V somewhere in here and then rocket out of there. The camel will pick this as a low down here and it'll be party time. So that's good. Also for XRP, this thing has been incredibly accurate, picking every single low, and you can see that it's had big pumps despite trading in this big range. Okay, this is, 126, 70%, 68, 37, 46. And we are on our way to this next timing window. That's what this green bar is. The indicator has painted that. Of course, again, the price should do something akin to this into that window, form a V. The camel will pick it. And I actually think, based on where we are in Bitcoin's longer term cycle, if some of these altcoins have got new highs left in them, it will be out of this upcoming cycle low that we see the new highs printed. So super exciting times. For those of you that were asking about the gold DCA, this has officially started. As of the first of the month DCA begun, it has started to accumulate some gold. And as and when the camel indicator picks daily cycle lows, which I think it has officially picked one at the moment as well, it will add a comparison here. And if you're already a member of camelfinance.co.uk, then you can go and check this out. All of that is on the left-hand side of the members hub. If you're not a member of camelfinance.co.uk, but you still want access to this, well, just make sure you're subscribed, tune in every day, and I will make sure we cover this as and when. Anyone that doesn't know, the idea is simple. We are going to prove that this indicator will get you a lower DCA, a lower average cost basis for DCAing into any asset, but we're just using gold as an example. And the reason we know this is because if you just use a first of the month DCA like this thing here is doing, then at some point, you're going to buy the ultimate high, you're going to buy the ultimate low, and you're going to buy every price in between. But the Camel Finance indicator will only pick entries for your DCA at major swing lows. So over time, that is the name of the game, to prove to you that even if you're not a trader, you're just an investor and you just like to DCA some asset every month, the indicator is still going to be able to help you do better and get higher returns over time. Now, we are officially one day out from FOMC. Currently, there is almost 100% probability that we are going to be remaining paused. If you've been following my channel, you will know I think this is over 100 basis points overly restrictive, and I actually found someone that agrees with me. The one area this guy disagrees with me is he's actually betting we're going to get a surprise cut today. Now, I don't think that's likely at all, and the reason I say that is anytime this CME pricing is north of 85% probability, I have never seen it be wrong. So there's a first time for everything. It's a market. Anything and everything is on the table at all times. But as soon as this number is in excess of 85% in any direction, I will always just assume that that is what is coming with 100% certainty. I've never seen it fail as long as it's over 85%. So that's the one area we disagree on. But this short thread absolutely nails the current situation, so I thought I would share that with you. Initially, Powell has declared that inflation was too high to justify lowering rates, yet inflation has been trending downward. We know this, the CPI has been coming down, the true inflation's been coming down, and in fact, it's fallen to the same level where he cut rates last year, but this time he didn't cut rates. And you can see that right here. Later on, Powell pivoted, stating that core PCE, which is the Fed's preferred inflation metric, did not support more rate cuts. However, this month, it actually hit 0% month over month. And instead of acting, he quickly began searching for fresh excuses not to cut rates and instead turns his attention to the unemployment data. So when it suits Powell, it's inflation is sticky, we're worried about being data dependent, we don't want to be premature to cut. And then as soon as PCE, their preferred inflation metric, comes in at 0% month over month, they immediately abandon ship on this idea. They clearly signal to everyone they are no longer data dependent, and they quickly begin searching for new reasons to remain overly restrictive. This is why I continue to beat that drum that I believe this is a controlled demolition. I do not believe this is incompetence. I do not believe this is anything other than engineering a hard landing over time so that they can justify massive amounts of printing, and that massive amounts of printing will later produce an even greater wealth divide, even more inflation, and even higher interest rates, and therefore debt defaults, which ultimately, towards the end of the decade, will be used to usher in those CBDCs. I hope I'm wrong, but we'll find out. Powell stressed that the employment of the everyday citizen is what truly matters to him, especially after he was proven wrong about his inflation expectations. However, as the visuals reveal, employment is actually showing signs of strain. I've been calling this labour market deterioration. It's well known that companies tend to be slow in pulling jobs postings, which means the real situation could be bleaker than it seems. Again, no surprise to you whatsoever if you've been following the weekend's deep dive. We continue to monitor the labour market deterioration, and it continues to deteriorate in front of us in real time. So what did Powell do during the election period? Well, take a look at this graph that shows the 10-year break-even inflation rate, which tracks Treasury market investors' average 10-year inflation expectations. Say that when you've had a drink. The red line shows that in November and December, Powell was cutting rates, inflation expectations were higher than they are now, and that's right. He lowered rates despite his own rhetoric. Why? There is something wrong with this man. I continue to make the case that he is up to no good. Maybe my tinfoil hat is too tight. I will leave that to you to be the judge. AWS here also sharing a graph comparing the 2-year Treasury yields to the Fed's interest rate. Back in 21, well before the runaway inflation hit, the 2-year yield spiked, sounding an early alarm. The Fed, however, was very sluggish in responding, and inflation soared as a result. But then since March 23, the script has flipped. The 2-year yields are now dropping, and the Fed continues to keep rates stubbornly high and overly restrictive. In other words, the market's pricing in a recession, but Powell is saying, no, we're going to remain overly restrictive. We are not going to be accommodative. And again, I think it is because this man is trying to deliberately engineer a hard landing. I know a lot of people think I'm absolutely crazy for that, and that's fine. I'm not asking you to believe me, but anyone that has followed markets and the 2-year yield relationship to the Fed funds rate for as long as I have or longer, I would think is probably leaning on this side of the argument as well. So up to now, I would say what a fantastic summary of what we are witnessing pertaining to the Fed funds, pertaining to Powell and the central banks, and pertaining to the current wider market implications with things like inflation and labour market deterioration. The one place I disagree with is this guy here is predicting a rate cut tomorrow. Like I said earlier, I don't think we're going to see that. I think it's near certain. I think it's as certain as we could be in markets that we're going to be remaining overly restrictive and paused, for the simple reason that anytime this number here is over 85%, it tends to be correct. But it was quite refreshing for me to find somebody that seems to understand what's going on here under the hood and seems to be able to look at this stuff and scratch their head and say, what on earth is this man doing? And if you don't think he's engineering a controlled demolition, then I would love to know what you think he is doing, okay? Is he just throwing darts at a dartboard? Is he engineering a soft landing? Like, what is it that you think, if not a controlled demo? I would love to know about it. The stock market, luckily for us, is not the economy. Right? And the stock market doesn't care. The stock market is continuing to bounce out of these half-cycle low inversions, and for the first time this year has moved into greed. So this is good. I interpret this as a move towards bullishness with momentum swinging in the bull's favour. On top of that, Kushi here pointing out when you divide the S&P by M2SL, okay, the setup at the hard right edge, assuming it goes straight vertical from here, is identical to what we saw back here. Okay, big push, huge violent backtest, V-shaped recovery to new highs, and that was all she wrote. So is something like that on the table? Have we had big push, okay, the snap back to the retest, and are we about to do something like this into that final blow off top high? That would be pretty wild. I would love to be able to stay on trend for that if possible. But again, I will need to see a little bit more from the market before I can start to champion that as the base case. However, under the hood, we do have more improving signs. The S&P 500 AD line is back at its all-time highs. And during the 5 previous occasions, which are marked by vertical lines on this chart here, after crashes, the lows were already in. So the bear accounts probably don't want you to know this, and I've got some really cool things that bears don't want you to know about Bitcoin in just a moment. But here you can see, okay, advanced decline line down the bottom hits new highs after a crash for the S&P, and the lows were already in, off we went, okay? Same in every other instance with one of these vertical lines. Tells us to keep an open mind about seeing higher prices walking forward for the stock market. And speaking of things the bear accounts don't want you to know about this current alleged top already being in for Bitcoin, is when we compare the current Bitcoin bear market to the previous ones, it actually looks nothing like it. Now, I appreciate at a first glance here, you might be tempted to say, well, it's not too dissimilar, Camel. It's not really too dissimilar. It could easily morph into a bear market. Yeah, it could. It's a market. Anything can happen. But it's been 105 days since the top at 109K for Bitcoin, and it's currently 14% from its all-time high at the current prices. But if we look at previous cycle tops, after 105 days, in 2013, we were down 55%. In 2017, we were down 66%. From the first peak in 21, we were down almost 40%. And the second peak, we were down almost 50%. So this 14% here does not speak to a top in the market. It speaks much more to a pullback, a healthy consolidation, reaccumulation, and now we have left behind the new weekly cycle and are making our way to new all-time highs. Markets in Bitcoin, particularly once they've topped, tend to top spectacularly, and that is absolutely not what we've seen this time around. Now, it gets even more bullish under the hood for Bitcoin, as we are now going to examine something that I personally find very interesting, intriguing, but also difficult to perceive based on cycles. But I want to lead in with this, okay? Not only does the current Bitcoin top look nothing like a Bitcoin top, but remember it's still really early, okay? And particularly when we think about it in terms of the S-curve of adoption, just 7% of this global population is actually invested in crypto. And most of them are probably not here as hardcore, die-hard Bitcoiners that cold store their own Bitcoin, right? Most people probably got a couple $100 if they're lucky in some meme coin that's down 99.99%. So a real number of global Bitcoiners, like true people that are willing to die on their back for a currency that's peer-to-peer and decentralized, is probably significantly below the 7% level. But Jordan here has made a very fascinating comparison, which is again derived from this S-curve of adoption, and the comparison draws parallels to Amazon. The linear regression models developed during Bitcoin's early adoption phase are limiting perspective. Volatility decay won't arrive until the late majority adoption stage. All current models will be broken, and the chart below aligns the S-curve of adoption with Bitcoin's current and projected growth path. Notice the Amazon versus Bitcoin trajectory. Amazon's exponential acceleration upon entering its early majority phase may provide a roadmap for what Bitcoin is now poised to experience. Bitcoin has just crossed into its ultimate opportunity phase. And institutional adoption is perfectly timed to drive Bitcoin's entry into the early majority phase, fueled by surging institutional allocations, Wall Street's entry via spot ETFs, and supportive US administration swiftly advancing regulatory clarity, which will unlock doors for banking integration and broader institutional investment. It's derived from this right here, okay? This S-curve of adoption. This one here is Bitcoin, okay? This one I'm tracing like this. And notice the one behind it, that's Amazon. Okay, we have this kind of initial hype phase, okay? Then it kind of smooths out into this next phase before ultimately crossing the chasm into the ultimate market opportunity. This is that up only forever type deal for Amazon. Now, don't get it twisted. There's still violent pullbacks and corrections along the way, okay? 40-50% dips would be expected, which would still perhaps give Bitcoin the opportunity to have that decline into its 4-year cycle low and then continue to rip higher. But notice again, this is all on dog scale, and maybe the days of these huge boom busts, right, are slowly but surely going to get left behind us, okay? The drawdowns that we saw in Amazon from here to here were monumental compared to the kind of corrections that we get at the hard right edge after we cross that chasm into the ultimate market opportunity. And it may just be the case that that's what we're going to see. We've already seen for Bitcoin, the bear markets diminish in volatility each cycle. Is it therefore possible that we'll only get 50% maybe, or 60% this time around into that 4-year cycle? And then from there, are 50+% drawdowns, certainly 70, 80% drawdowns, a thing of the past? I don't know. But what I do know is, when I look at this kind of chart here, this to me is probably how the likes of Michael Saylor and BlackRock see it. This is to me probably representative of what is coming in the years to come. And I think regardless of whether something like this plays, or we just continue to do what we always do, which is blow off, crash 80%, blow off, crash 80% every 4 years or so, I still think the overall trend is up and to the right. And I still think that to say that we are late to Bitcoin is simply ridiculous. Also, to say things like, yeah, well, there's not much gains left in the Bitcoin market, okay, is absolutely absurd. Okay, multiple millions of dollars a coin seems programmed right around that same time frame. I expect to see 20k plus gold ounces. So if you can stick around, do the basics right, I still very much maintain that you're going to be able to change your life over the next 5 to 10 years or so. And check out gold as well. Breakout, retest, possible resumption from the channel. Okay, if true, then 4K is coming next for gold. And it looks an awful lot to me like it's trying its best to confirm a daily cycle low. One thing I would be a little bit mindful of is the 2 drives. First things first, this is slightly early for a gold cycle low, 17 bars. Okay, normally we'd expect to see it 22 to 26. That makes me wonder if this will resolve to 2 drives like this. And then off we go. Maybe, just maybe, that's what's coming. If so, extremely bullish buy setup out of that second drive to the downside. But again, when we look at silver, it looks like it kind of wants to go here, doesn't it? So not quite convincing enough for me to hop in here. And again, a little bit early. I think we want to adjust this trend line to here and see what can happen. I would love to see 2 drives into here. So we've had 1, let's get 2, and then we can go. And also that would bring the count up from a mere 18 days to something like 22, 24. So let's see if we can get that, and then it should be time to go long, either out of a swing or a trend line break, but keeping a close eye on that. Still positioned by a SILJ, which I suspect will be getting ready to break out. And if it can break out here, it might be time to add as well and move stops up. That's another thing. Something like this, and then move the stop up from the first position. But we'll deal with that in the level 3 members section. Needless to say, Bitcoin, as I said right at the start, is in that timing window to get a cycle low and go. And then, of course, it should be time to get to full exposure with these crypto stocks. Many of them have done what I expected them to do and what I was talking to the members about, which is start to get a pullback into that FOMC timeframe, and then we can look to get hold of some trades. So far, so good. Again, if you're a level 3 member, we'll hop into some of those during the rest of this week, I should think. And other than that, happy days, right? What an episode. I hope you enjoyed it as much as I enjoyed presenting it. And I hope you're doing well in life. All right. Trade safe. Take care. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass. Oh, yes, indeed. Camel